among the things that we try to do more or less as just professionals is to not take a political side on this, and we'll try not to do that. There's a couple of things that personally I just wanted to point out is that when tax laws are brought to the floor, we hope that they're good tax laws. To give you an idea as to sort of how this was being made, the Senate passed its bill at 2 a.m. on Saturday morning. They started sometime on Friday, and they did this thing called something called a vote-a-rama, which sounded sort of weird to me. I did a little digging as to what that means. Is that they basically take all of the amendments that have been brought to the floor, take 10 minutes of discussion for these amendments, and then vote yay or nay. If they get yay, they're part of the bill. If they don't, then they're cast aside. And so what this means is that we're going to have a law that may not make sense as you look at it as a whole. And it's because of the way it was brought to bear. Not to say that one's better than the other, but it just shows you that there are some things that are going to make total sense, and there are some things that you're going to wonder, how in the world did this pass? How did this get in there? And it's part of the process. Right, wrong, or indifferent, it is what it is. So with that, we're going to move to our first slide. So our intentions here is to go over the items that we have in the two bills. Justin and I are going to go over the corporate and business sections of it. We're going to go over the rate drop, which is huge and actually the main driver as to how all of this got started. We may not go into a lot of the history for the rate drop, but the fact that we are going from a 35% corporate rate to a 20% corporate rate really will just merely puts us in line with the rest of the developed world. It's something that's probably been long overdue, and in the giant scheme of things, that actually makes some sense if you look at how things were quote unquote meant to be. Among the things that we're going to talk about are capital expensing of equipment and the incentives to take advantage of these cost savings. Bob is going to go over the territorial system, the impact on earnings, and some of the international sides of things. Joining Bob, Justin, and me is Jim Wilhelm. Jim is the tax director here with us. He is going to jump in and throw in some commentary and make some points that we want to highlight. The first thing that we want to tackle is one of the things that is high on everybody's list of things to pursue, and that's the how pass-through income is going to be taxed. And so we actually have two very different attacks on this. In the slide, you'll see that one is relatively simple and straightforward, and that's on the Senate side, where it basically says it's going to allow a deduction 23% for income that is passed through from the entity to the individual or to essentially the owner. On the House bill side, instead of having a deduction, they're actually going to reduce the rate down to 25%, but it's only on 30% of the pass-through income. The remaining 70%, based on the House bill, is going to be taxed at the ordinary rate. Neither of these apply to professional service firms, architects, accountants, attorneys. Those kinds of items typically have had their own sort of special treatment. Typically, if they were incorporated, they were at the highest rate of 35%. They will not get the benefit of either the 25% on the 30% at the House bill or the deduction for the 23%. So within SC&H, a large part of our practice revolves around these pass-through entities for a couple of reasons. One, because they've been tax advantaged. So now with the drop in rates, the corporate rates from 35 to 20%, these may not be so tax advantaged. The other reason to have these types of pass-through entities is because of the availability of cash. If tax was paid and you had basis in these entities, then you could withdraw the cash, again, because the tax has already been paid on it. So that's been a very important item and something that needs to be brought to the fore here. The C corporation rate at 20% still means that if cash is withdrawn from a C corporation, that has something called earnings and profits, and we won't get into that. But if the C corporation has earnings and profits, there are dividends to pay for the recipient. And so those dividends currently are at 20%, actually 23.8% if you include the Medicare tax on that. So it's that combination of, or that comparative C corporation with dividends versus this tax rate for the pass-through items. So working through just a quick example without using any slides or anything like that, if your income that was passed through, and I'm going to focus a little bit more on the Senate bill, and Jim, you might interject. I don't know if the Senate bill is stronger than the House bill, if there's one leaning one way or another, and you can jump in right after the example. If we have $1 million being passed through to an individual, that $1 million on the Senate side will be reduced by 23%. So the tax on that will be $770,000 worth of taxable income at the highest Senate rate of 38.6. Mathematically turns out to be 29.45%. So then you start to make your comparison of 29.45% versus the 20% corporate rate. But that's not really that relevant because the corporate cash is still in the corporation. You haven't withdrawn anything from the dividend side. So if you were to withdraw that money, obviously the rate is going to be higher, probably in that example by about $100,000. So it may be something where you really have to look, not necessarily at 1 year, but somewhere down the road to avoid this double level of taxation. So, Jim?
Sure, a couple quick comments. So if we look at the House bill versus the Senate bill, assuming one is the active owner or one of the active owners of a trade or business, essentially the effective rate under the House bill would go from 39.6 today to about 35%, maybe 34% for an active owner of a trade or business after you go through the somewhat convoluted math that's in that bill. The Senate is a little more straightforward, as Angelo mentioned. You get to a highest marginal rate of roughly 30%. So the Senate bill is a little more favorable. Of note, the Senate bill initially was going to have a 17.8% deduction for pass-through entities, because 17.8 is just a cool number, I guess. That was moved up to 23% with some last-minute lobbying from a couple senators. On the House side, excuse me, I think they kind of stayed with that number really all throughout. However, one thing that was in the House bill that went away, and just because it went away doesn't mean it can't come back, is that all pass-through income, so all income to active owners, all income to passive owners of S corporations and partnerships, as well as sole proprietorships reported on a Schedule C, would be subject to self-employment tax, which would be a significant change. Now, many of those same individuals would have that income subject to the net investment income tax without the self-employment tax being assessed. So maybe the trade-off wasn't a big deal, but if you were a passive owner in real estate partnerships or some other type of investments, you probably weren't being assessed self-employment tax. And if you did not have other earned income, it would have been a significant tax increase. So that went away in the House bill. As the House and Senate get together and argue for their favorite breaks or issues they want to push forward, they will be seeking dollars. So we're going to keep an eye on this and see if this isn't brought back into the discussion as a way to generate additional revenue.
Okay. With that, we're going to go to a polling question. The question is, the Senate bill will allow a deduction against pass-through income from partnerships and S corporations at what percentage of earnings? We'll give you about a minute. Very good. The answer is D, 23%. So we'll move on to the next slide. Thank you. So as Jim alluded to, one of the things that we typically tackle is the self-employment tax, and he was spot on as far as the items that are in here. The self-employment tax is pretty hefty. It can be as high as 14.13%, doing a couple of machinations with the math and the way it's calculated, but tax at 14% is pretty significant. A couple of things that we want to point out is that as it currently stands, is that nothing has changed, and you'll see it's identical at both the House and the Senate. As Jim alluded to, this is no guarantee. So among the things that we will continue to do is have reasonable compensation to S corporation shareholder employees. That's a very, very important piece. And then as part of that, we always are aware that pension contributions to active shareholder employees is based on the W-2 wages. And so the combination of things will continue. For partnerships, an active member or active partner is going to be subjected to self-employment tax on all of his or her earnings. Okay. With that, I'm going to turn it over to Justin, and we're going to do cost recovery.
Okay, thanks, Angelo. As it's on the learning objectives, one of the main focuses of the bill was capital expensing for businesses. And regardless of whether you're talking about corporations or pass-through entities, capital expenditures, depreciation, and accelerated expensing have been legislative topics that have come up at year-end for the past few years. Going into 2017, as it stands now, the Section 179 expensing deduction was limited to $500,000 with a total investment limitation of $2 million, which was set to increase for inflation. And bonus depreciation was set for 50%, and this would have declined to 40% in 2018. Additionally, the ability to expense lower cost assets under the de minimis safe harbor election was still available under the tangible personal property regulations. The proposed tax bills both make significant changes to cost recovery and immediate expensing options for fixed assets. Both the House and Senate bill would double the bonus depreciation from 50% to 100%. However, the time frame that this would set in would be different. The House bill allows for 100% bonus depreciation for assets acquired and placed in service after September 27th, 2017 and before January 1st, 2023. The Senate bill has the same effective date of September 27th, 2017, but would phase out the expensing between 2023 and 2026, sliding down from 80% to 20%. Additionally, under the House bill, used property, which originally has not been eligible for bonus depreciation, if it's first used by the taxpayer, would apply. This expansion of the definition has not been included in the Senate version of the bill. Both bills also do not include real estate, trade, or business property as qualifying property for bonus depreciation. And both bills repeal the election to use AMT credits in lieu of accelerated depreciation. In regard to 179 expensing, the House bill would raise the current limit from $500,000 to $5 million with a $10 million investment phase-out threshold. And this would be effective starting in years after 2017 through 2023. The Senate bill would increase allowable expensing under 179 to $1 million with a $2.5 million phase-out, but this would be a permanent provision going forward. Over the past 15 years or so, we've seen bonus depreciation range from 0 to 100% allowances, so this would be a major impact for depreciation. So as for year-end tax planning ideas for cost recovery and immediate expensing, kind of the status quo here and same as prior years. If there's a valid business reason to purchase equipment by year-end, then you should do that and purchase it by year-end. Accelerating these deductions into 2017 to lower your taxable income when rates could potentially be higher could always save some valuable tax dollars. So keeping kind of in the idea of capital expenditures, real property depreciation. As has been custom in prior years, bonus depreciation in Section 179 do not apply to real property. So for real property, the House bill actually makes no changes to the recovery periods for real property depreciation, meaning that non-residential real property would remain at a 39-year recovery period, and residential rental property would stay at 27.5 years. However, under the Senate bill, there are some proposed changes. This bill would change the recovery period for non-residential real property and residential rental property to 25 years, going from 39 and 27.5 to 25 years. Additionally, the recovery period for qualified improvement property that is currently at 15 or 39 years would be reduced to 10 years. And the special 15-year recovery period for qualified leasehold improvements, retail and restaurant property would be repealed. So for 2017, before any of these changes go into effect, you may want to consider reviewing your current and prior year asset acquisitions to determine if a cost segregation study could make sense. This study could be beneficial in reclassifying assets to a shorter tax life. You would also probably want to look, as I alluded to in the past slide, to expensing items that you can now and accelerate those deductions in the current year. However, when you look at accelerating expenses in the current year for capital expenditures, you may also want to take a look at the impact on your financial statements. Moving on back to Angelo to discuss the net interest expense changes.
So the deduction of interest expense has long been in the code, I think almost from its inception going back. I believe it's probably a revenue raiser. Well, effectively it becomes a revenue raiser because of limitations on the amount of the deduction. Not sure exactly politically how this came through, but obviously with the reduction in the deduction for interest, banks are going to be affected, people are going to be affected in various ways. When you look at what this is going to do, there may be some implications economically. So let me get into the nuts and bolts of what these limitations are. So on the Senate side, every business, regardless of its form, is subjected to a disallowance of the deduction for net interest expense in excess of 30% of the business's adjusted taxable income. Adjusted taxable income has its own definition that basically is the net income without regard to business interest expense, business interest income, the deduction of certain pass-through items, NOLs, and depreciation. So it does allow for some of the deductions, but it's basically a form of what businesses would know as EBITDA. And so the deduction is going to be limited to that amount. In addition, there's an overall limitation that says if you have no taxable income, you don't get an interest expense, so you can't grow your NOL by the interest expense that otherwise would have been allowed. So the House similarly has the same types of provisions with a different example, a different allowance for what the definition of taxable income is, and in that case, it doesn't include depreciation. So it's a little bit different than the House bill. The Senate bill. The House bill allows for a 5-year carry forward of any interest expense that's disallowed. The Senate bill has an indefinite carry forward period, so as long as the entity continues to exist, it exists as well. Both the House and the Senate bill allow for small businesses to not be limited as far as the interest expense is concerned. The Senate bill defines small businesses as those with receipts of $15 million or less gross receipts. The House definition is $25 million of gross receipts. So very often we get into the weeds as far as naming code sections and things of that nature. Section 179 that Justin just alluded to. I'm going to refer to a code section here as well under section 448 that defines what gross receipts are, because it's going to be a big deal as far as planning is concerned. 448 and the definition of what meets these $25 million and $15 million of gross receipts is the trailing 3 years average of gross receipts. So if you were to determine whether your gross receipts averaged $25 million, you would look at 2016, 2015, and 2014, divide that by 3, add those together, divide by 3 to determine whether you are a small business with regard to this. And so among the things that you might consider doing is trying to measure whether you are a small business or not, and to see whether you have these limitations. Jim, did you want to comment on the interest expense limitation?
Sure. One comment is that for the Senate and the House bill, I think we might have that reversed. The Senate bill, the 30% interest limitation is applied to adjusted taxable income, which is defined as taxable income before interest expense. The House bill has a friendlier definition, which is 30% of EBITDA, which is income, add back interest, add back depreciation, and amortization. And so from our client's perspective, should this go through, we vote for the House bill. It's going to allow more of an interest deduction than the Senate version would. There's been some discussion about who would be impacted by this provision. Both do have, we'll call it a small business exception, which is helpful. I think a lot of this language comes from Congressman Camp's tax reform treatise that he put out 3 years ago. And actually, it was also in President Obama's budgets and comments about tax reform over the years as well, with concern about companies being over-reliant on debt. And so if there is less incentive in the code for companies to have debt, they would utilize equity or other means to grow their businesses. So I think that's kind of the philosophical argument for putting that in here. In the real world, should one of these proposals go through or a combination thereof, there will definitely be impact on clients or companies that are in capital intensive businesses where they are buying a lot of equipment. I believe real property trades and businesses are exempt from this rule, which is good because it would probably wipe out 25% of the value of every piece of commercial real estate in the United States. If they did this, it would be devastating from a tax standpoint. But for larger companies that are over the thresholds, that are capital intensive, it's going to be a problem. So on one hand, you would get, as Justin talked about, you could expense a lot of equipment. On the other hand, you could have your interest expense limited, and that's what you incurred in order to go buy said equipment. So there will be competing issues when you look at taking 179 expensing and how rapidly you are depreciating assets versus your ability to deduct all of the interest. Yesterday I read, the banking community is not very happy about this provision, just like they aren't super happy about limiting mortgage interest, and we'll see what comes out of Congress, I guess, in the next couple of weeks. Right. But for folks looking at, their cap table and how they're financing their business, should this go through, it's really going to start to change the dynamic and essentially guide new and existing businesses to look to the equity markets more so than traditional lender markets, which I guess is the intent of this proposal.
In addition, Jim, I've read that the reclassification of rent versus rent as operating expenses as opposed to rent as financing expenses may kick in at that point in time, and so people will want to rent as opposed to borrowing and buying. So that may be another outside ramification of what's going on. So with that, let's go to our next polling question. Under the House bill, to what percentage is the interest deduction limited? Okay, we'll move on. The answer is B, 30%. Our next slide is regards to net operating losses, and this too is one of those things that I guess is sort of controversial, but not really. The net operating losses, according to the House bill and the Senate bill currently, is that NOL carry forwards will only be allowed to offset 90% of taxable income. And then also it repeals carrybacks. So currently, carrybacks, with the net operating loss, a carryback is allowed to be carried back 2 years and then forward for 20. Under this provision, that there would no longer be any carrybacks available, that they would only be available to carry forward. This has some interesting implications in the world of companies that report to the SEC and are publicly have public disclosures as to how these would be shown. There's something called a valuation allowance that would be affected by having an indefinite carry forward, and so that's another thing that we're going to be looking into. There is a difference between the House and the Senate bill. The House bill will actually drop to 80%, drop this limitation, so that the offset can only offset, the NOL can only offset up to 80% of the taxable income. And so there's a limitation there as well. The House bill allows for small businesses and small businesses to carry back 1 year. And so there's an exception for small businesses. And that definition is $5 million of gross receipts. Once again, we're getting a whole lot of different concepts, a whole lot of different levels that add to the complexity, and you can see that it's really because of the disparate amendments that are being kicked back and forth and the way that this bill was set up and is carried forward. So our polling question, the Senate bill will allow for carrying back net income losses in all cases. Okay. The answer is false. Moving forward, Justin.
Okay. The meals and entertainment expense deduction. So in addition to some other deduction changes moving forward, both bills are now disallowing deductions for entertainment expenses and membership dues. No deduction would be allowed for transportation fringe benefits, on-premise athletic facilities, and other amenities provided by the employer. These benefits would now only be deductible to the business if treated as taxable compensation to employees as part of their gross income. These changes will go into effect for expenses paid or incurred after December 31st, 2017. The 50% deduction limitation would continue to apply to expenses for food and beverages. Moving forward under these provisions, businesses should evaluate how certain benefits provided to their employees are tracked, recorded for purposes of reporting these to their recipients. Also, before year end, as a tax planning point, you may want to consider accruing or paying expenses related to entertainment, meals, or employee fringe benefits. If these provisions go through, you can take advantage of these deductions in 2017, and if for some reason it's not, you still defer the income into a future year, which could potentially have a lower tax rate. So with that, Angelo is going to talk about some changes to accounting methods.
So, as most people who deal with the tax side of things know that you can have financial statement reporting and then tax reporting. Very frequently, the tax reporting under the cash method provides flexibility that's not allowed under what we'll call GAAP financial statements. This has been allowed for a couple of different reasons, although there's sort of a way to affect the timing of when you pick up the income. It has always been felt that this was merely a timing issue and has been allowed for quite some time. So I think the general consensus is that it's better to be on the cash method of accounting for the most part. There are some very specific reasons why the accrual method of accounting, which is typically the other method of accounting, would be more beneficial. And we won't get into the nitty-gritty details of that. But for the most part, generally cash method is more flexible and the one that people tend to cling to. The House bill will allow for cash method reporting if the business has gross receipts of $25 million or less. Again, this goes back to the Section 448 definition of gross receipts, which is the trailing 3-year average. The Senate bill will allow cash method for gross receipts of under $15 million, a little more restrictive as to who can use the cash method. And so that's sort of generally in there. It's interesting. One of the things that we think may happen in looking at what the ramifications are of the drop in corporate rates is that some S corporations will convert from S corporation to C corporations. In that situation, S corporations, which may have been on the cash method because of certain specific exceptions, will no longer meet those exceptions, and those S corporations, formerly S corporations, now converted to C corporations, will have to change its method of accounting for tax purposes from cash to accrual. There's a special provision that will allow a 6-year ratable inclusion of income, which is much greater than the current 4-year inclusion of income, that essentially recognizes this as a pain point that Congress is allowing to extend for an extra 2 years.
There's a couple of other, I guess we'll call them accounting, but they fall under accounting method rules that would apply with these same thresholds. The first would be for contractors, for how you account for long-term contracts. You could avoid utilizing the percentage of completion method under tax reporting if you were under the either $15 or $25 million threshold. And then there's a slightly onerous code section called 263A or UNICAP, which would also not apply in these provisions for companies under those thresholds. Right now, those provisions for both long-term accounting, long-term contract accounting, and inventory accounting apply to much smaller companies, so this would actually be a piece of good news.
Compensation. There's long been, there's been a limitation on the amount of compensation that's deductible for publicly traded companies. That limitation has been $1 million, but there was a specific exception that said performance-based compensation would be allowed as a deduction. Under the House and the Senate bill, those exceptions go away, so that the limitation on certain officers of those publicly traded companies would be limited to the $1 million. So because these are public disclosures, you often see sort of splashy headlines that says so-and-so was paid X millions of dollars. Very frequently, they were paid some amount and then had performance bonuses on top of that, which allowed them to be a deduction. Assuming that one of these two provisions go through, that is going to be limited currently. So in addition to publicly traded companies, the House bill indicates that SEC registrants that are not publicly traded would still be subjected to this limitation. So there's there's some limitations that are being kicked in here. And interestingly enough, once you're covered by this limitation, no matter what you do for that company, the $1 million limitation would follow you around, so that if you become, we'll say, chairman emeritus or some other kind of position where you would get more than $1 million of compensation, it would still be limited to that deduction. Another revision that is in both the House and the Senate bill is something called like-kind exchanges. Like-kind exchanges allow for deferral of gain for properties that are used in a trade or business, so that you can trade in one, buy a new one, and defer the gain on the old one. So what has happened here, I'm sorry, so let me get to the exclusion. There's an exclusion for real property. Real property like-kind exchanges are still good. The ones that are being targeted here are equipment and things of that nature. So to give you an example of a like-kind exchange, a landscaper goes out and buys a $70,000 chipper, and it uses it for a couple of years. It becomes fully depreciated under some of these accelerated depreciation methods. So it has a tax basis of 0. He bought it for $70,000 and has depreciated it in its entirety. It turns around and says, I've got this cool new chipper. There's a new generation of chippers that are coming through. We're going to take this old chipper that is now 2 and 3 years old, get a new one. The new one is now costs $85,000. The 2-year-old chipper that I'm going to trade in has a value of $20,000. So the $85,000 one I'm going to pay $65,000 for. Under the old rules, you could defer the gain being $25,000 of fair market value versus your tax basis of 0, and not have to pick up that $25,000. Under these new rules, you do have to pick up that as gain, and the basis in the new chipper is at $85,000. In theory, we should be able to end up in the same place if I can take an expensing election that Justin alluded to. So sort of no harm, no foul. It actually makes it a little bit easier, because GAAP financial statements never had this fantasy of like-kind exchanges, but to sort of know that it's out there, it's sort of industry-wide. You see it on cars, you see it on large pieces of equipment. Again, this exclusion for like-kind exchanges does not apply to real estate, where most of these like-kind exchanges live. Justin, if you want to tackle the production activities deduction.
Sure. So for the Section 199 deduction, also known as the Domestic Production Activity Deduction, or DPAD, has historically been a popular tax advantage to manufacturing, construction, and production taxpayers. Under both bills, this deduction would be repealed. The difference between the two bills is that in the House bill, the repeal would happen for tax years occurring after December 31st, 2017, while the Senate bill delays the repeal for 1 year to match the reduction in the corporate tax rates in their bill. So in other words, the Senate bill would repeal the DPAD in 2018 for pass-through entities and 2019 for C corporations. Continuing with the theme of repeal deductions, most of the business credits will also be repealed. The current bill keeps 2 business credits, the research and development credit and the low-income housing credit, but most other ones will be eliminated. For the R&D credit that remains, the House bill added language to the existing credit, stating that R&D expenses are required to go under a 5-year amortization expensing process. The Senate bill will generally follow suit with that. The repeal of these taxes, or the repeal of these credits, have been justified by the lowering of the tax rates. Again, for 2017, accruing and paying R&D expenses or any other expenses that you could get a credit for by year end would be beneficial and help accelerate that tax benefit in a year when we know you will be able to get that credit.
The last slide that we're going to have for the business side of things is alternative minimum tax. We went a little ways with the House bill, and we're very excited the fact that the corporate alternative minimum tax was going to be fully eliminated after 2017. Lo and behold, the manager's amendment to the Senate bill reinstated it although they did increase the exclusion. We're sort of unhappy to see the AMT that may survive. We sort of don't like AMT. It has a level of complexity that we don't think is really justified. As Greg mentioned, for individuals, there's going to be less people that fall into AMT, and that may be true for the corporate side as well. But the fact that it still exists is rather unsavory, at least from my perspective. If it does go away, there are provisions for those who had alternative minimum tax credits to be able to claim those credits going forward in 2019 through 2021.
I would expect they're going to have to do something with corporate AMT because the AMT rate for corporations is 20%. If you lower the rate to 20%, if you have $1 of AMT adjustment, you're paying AMT at the corporate level. Any corporation that would have R&D credits would not get any benefit until there's a difference between their regular tax and their alternative minimum tax. So if those rates are the same, effectively the R&D tax credit would be useless. Pharmaceuticals and other industries that are heavy into R&D have been lobbying for the Senate and Congress to take a hard look at corporate AMT.
Sorry, go back. Can you go back? Okay. So our last polling question on the business side of things, alternative minimum tax has long been an incendiary topic. Both the House and Senate will repeal corporate AMT. True or false? Great. The answer is false. Okay. We do have one more topic that we want to talk about with regard to carried interest. Carried interests are partnership interests typically provided to service providers. That's a very oversimplified approach to it, but for our discussion purposes today, the carried interests portion, which typically will get long-term capital gain treatment. Long-term capital gain treatment was allowed for holding the interest for 1 year, more than 1 year. Both the House and the Senate will change that so that it needs to be held for more than 3 years. And so it's a bit of a hit to those who do have carried interest, but not very much. Typically, those are held for some extended period of time in order for the investment to appreciate in value. With that, we're going to turn it over to Bob. I'm sorry, questions. I'm sorry. Questions. Great. Let's do the second one. So with the first question that we have is, with the Senate version of pass-through income, are there any implications for a guaranteed payment and the 23% deduction? What they're referring to is a guaranteed payment is payment for services by an owner member or an owner partner. The way that the 23% is currently structured is that the guaranteed payments would reduce business taxable income before the 23% kicks in. Go ahead.
So we have a question that asks about how capital gains and qualified dividends will be taxed. under, with the new brackets and under either tax bill? And the answer is neither bill is changing how, generally speaking, how investment income is taxed. So there would still be maximum rates of 15, I guess, at 20% for cap gains and dividends. If your marginal rate is lower than that, then you would pay at the lower rate. So the capital gain and qualified dividend rates are not changing. So if your marginal rate is under that, then you will get some benefit due to that.
It would actually, it won't be worse. It could be better.
Correct.
Depending on your taxable income. Yeah.
Go to the question right above it. Okay. So in the Senate version with respect to the pass-through entities, how does this work with tiered entities that each get a deduction of 23% of income that could total a deduction of actually more than 23%? The way it's currently written is it's a per filer. There are some provisions for tiered that's not very clear, and the IRS is going to be given the job of trying to determine how best to do that. The language in the Senate bill basically says per filer. So, we do have a lot of other questions. We are going to take those offline and provide you answers with those so that we can keep moving forward and getting the international side that Bob is going to tackle.